practice, welcome to working to harness risk transfer for the common good. This is our very first event, and we are so pleased to have you with us. I want to begin by saying that, of course, our hearts and our thoughts are with everyone who's suffering right now from the devastating fires in the Los Angeles region. But I also want to be clear at the top that the session today is not about emergency needs or response for fire victims, nor is it about how those victims can navigate the insurance process. This was a previously scheduled event thinking about parametric insurance, and so that's going to be our focus today. We did, though, get some questions on the overlap between parametric options and wildfire, so we will hopefully talk that through a little bit. The idea of these Q&A sessions is to give folks an opportunity to get their questions answered by leading experts. So I am very pleased that we have 3 people with us today that I consider to be the very best to talk to in the country about parametric insurance. I'm going to let them introduce themselves and their work shortly, and they're here to answer your questions about what parametric insurance is, how it can be used, what opportunities it provides, and what the challenges and difficulties are as well. We are not going to be able to get to all the questions that came in today. The ones that people submitted in advance through the form that we circulated with registration are going to be given priority. That said, please put any questions that come up during this conversation into chat. We will try to work in any that we can, but for any questions that don't get answered, we will be following up with answers through a blog post or some other means. So we're going to make sure everyone gets their questions answered one way or another. Let me start by just really quickly providing a quick definition of parametric insurance, and then the esteemed guests might want to add more subtlety and nuance and explanation, but just to get us all on the same page. Most of the insurance that most Americans are familiar with is often referred to as indemnity coverage, and it means that you will be compensated for the losses that you sustain subject to the terms and conditions of that policy. That means a loss adjuster or person will come after you sustain property damage and assess the amount of repairs that are needed. Parametric insurance is different. Instead, you would receive a predefined amount based on what's referred to as a triggering event. And that can often be a measure of the hazard itself. So think, for example, wind speeds exceed, a certain speed within so many miles of your house, and a predefined amount is automatically transferred when that happens. So it can be fast, it can be flexible, and those provide some new tools for insurance. So that's what we're going to talk about today. So today we have with us Jonathan Gonzalez. He's the CEO of Raincoat. We have Kate Stillwell, the president of Parametric Insurance at Neptune and founder and CEO of Jumpstart Insurance, and Alex Kaplan, executive vice president for alternative risk at Amwins Group. So I'd like the 3 of them to start by introducing themselves by talking about a parametric product or project that they were involved in, to give some examples to get us started. So Jonathan, why don't you start?
Hey everyone, it's very nice to meet you all. So Raincoat, we specialize in developing parametric products that are intended to be embedded into large distribution channels. Those channels can include government entities that want to provide financial safety nets for specific communities, or it can be channels such as banks that want to protect loans from the potential disruption of these climate events. So we're a software-heavy kind of startup. Products that we've launched microinsurance products in markets like Puerto Rico, government backing FEMA-like structures in places like Mexico, and then loan protection programs in Colombia. So we have a bit of experience kind of worldwide across different regulatory environments, and it's really interesting to kind of see how this category continues to evolve.
Jonathan, over to you, Kate.
Thanks, Carolyn. It's great to see so many familiar faces and a lot of new ones too. So real pleasure to be part of Insurance for Good's first event. I founded Jumpstart Insurance, which created a direct-to-consumer earthquake parametric. So it was the first of its kind in the United States, consumer parametric, and it was for earthquake risk. I sit in Berkeley, California, less than 200 meters from the Hayward Fault, and also less than 200 meters from the boundary of the 1991 Oakland Hills fire. And so my neighbors and I live with this constant threat of natural disasters. And the idea for Jumpstart was to fill a protection gap because Americans, Californians not included, 90% of them are not covered for this very extreme risk of earthquakes. And the idea is to provide a product that provides a $10,000 payout immediately after a large earthquake for a cost that is 1/10 the cost of indemnity earthquake insurance. And the idea is it's not enough. $10,000 is not enough to rebuild your home, but it's enough to get a jump start on your process of recovery, which is why we called the company Jumpstart. We sold Jumpstart, the company. We started selling policies in 2018. We sold the company to Neptune in 2021. Jumpstart still operates as the Jumpstart brand, but we are wholly owned by Neptune Flood. And I am thrilled to be continuing the journey on Parametric within Neptune.
Great. Thanks, Kate. Alex?
Great. Thank you. Thanks, Carolyn, for organizing. Good to be with you all. So I'm with Amwins. I've been with Amwins for 5 years. I've was with Swiss Re for a dozen years before that. And so I've been in the parametric space for almost 16 years. It seems like a very long time, given how relatively new parametrics are. It's been a tremendous joy to see the evolution in the space and the innovation that's occurring at a faster and faster pace. So I've gotten to take part in many product designs and different projects around the globe. One that we recently launched back in September was a structure specifically designed for municipalities in California to help them deal with the economic consequences of atmospheric rivers. It's not something that had ever been done before, but the premise of the structure is to compensate them for the economic disruption, whether that be physical damage or otherwise, when there is water where it's not supposed to be. And so that was launched in September and already binding policies. So we hope that more communities will take part in it.
Wonderful. Thank you. I'd like to start with a question that we get a lot, and I think your initial introductions already started to get at this, but let's kind of probe it a little bit more, which is, can parametric approaches replace traditional insurance or indemnity insurance? Or if not, when are parametric approaches useful and what can they do that's different than our traditional indemnity approaches? Or could you provide some guidance to listeners on when they should be thinking, oh, this is a problem that parametric is better suited for than our standard insurance approaches? I'm opening it up to any of you. I'm sure you all have thoughts on that. So one of you jump in first.
I'll jump in and say that the best explanation of this came from one of our customers. You know, Alex has been in parametrics for 16 years, and for me, it's now this year is going to be 10 years. And in all those 10 years, until this customer said this, this hadn't occurred to me. But the answer to my answer to the question is no, because parametrics are like your paramedics. It's like saying, if you have EMTs, do you still need hospitals? Yes, of course you need hospitals. And my customer was the customer, what he said was, parametric, that kind of sounds like paramedic. And that's kind of how it works, right? It's like the first responder for your finances. I was like, yeah. And can I use that in our marketing? And he said, sure. Does that mean I get free policy? I was like, no, but I will send you some swag, some company swag. So it's like the first responder for your finances. And so you still need the complete solution.
That's a great.
Yeah, I mean, I agree with what Kate just said. And I would add a caveat to that. I mean, I think it depends on actually what you're actually trying to achieve, right? I think both have a critical role to play. I think of indemnity insurance as asset protection. And I think of parametric insurance as balance sheet protection. They serve two entirely different purposes. They work really well together. If your objective is to cover one particular risk, which indemnity may not be suited for, a parametric very likely could be a good alternative and may cover the risk in a more comprehensive fashion. So they work really well in tandem. I have plenty of clients that used to buy traditional indemnity or never bought traditional indemnity and only buy a parametric because they're only worried with around one particular source of exposure.
I have a bit of I agree 100% with everything everyone has said. I guess my kind of contrarian take a little bit is I think as it stands right now, parametric products serve very, very different functions, and those functions can definitely work in environments where maybe a traditional one could work as well, and then a parametric is preferred, like what Alex just mentioned. I do believe that said that given all the technological advancements that are happening at the rate that they're happening, I wouldn't be surprised if in 4 to 5 decades, parametric insurance gets to a level of sophistication where it seriously does start to potentially offer real serious solutions against certain traditional cases, because the fundamentals of insurance are still the same, right? Insurance is based on some sort of an event that's happened, a measurement of the intensity or the losses created by an event, and then trying to make a person whole again from a fundamental perspective. There's really no reason why you couldn't get a parametric product that is as sophisticated enough to precisely, accurately detect that if you have enough data and enough visibility. It's kind of like what you've seen with AI and ChatGPT, right? Like uh, LLM models are based on trillions of parameters. If you had an insurance policy that could process trillions of parameters, it would be a parametric policy, but it would feel very different, right, than in the current sense. So it's a little sci-fi to the future, but I really do think that it's a category that is moving in a clear direction, and it'll be really exciting as the years come.
So I agree with what Jonathan just said, but I'm going to be way more aggressive. I don't think it's 40 to 50 years. I think it's more like 15 to 20. And the reason I say that is if 90% of all data in human history was developed in the last 2 years, right? The computational power of the industry, the utilization of remote sensing technology, satellite data, et cetera, the confluence of all of those things is going to accelerate this at a pace that I think we can be more aggressive. I think maybe I'm drinking my own Kool-Aid, but I agree with the broader point.
I'm going to rewind back into the present and say that the parametric is fit for purpose when the funds that you are getting can be used for discretionary purposes. So that's like the number one feature of parametrics today, is that the funds are used for discretionary purposes. So if your insurance doesn't cover something like business interruption or certain extreme climate events, then parametric is a potential solution because it's excluded or not available from your regular insurance.
That's great. I just want to make sure that all our audience caught some of these points that you all have raised. So on that, our traditional insurance models compensate for property damage, right? So what you are all saying about parametrics is that they can be used for a much wider range of economic losses, things that aren't covered. Kate, as you were starting to say, Alex, the kind of balance sheet losses, lost income, lost revenue. And so it opens up, to Jonathan's point, getting closer to being economically whole by covering things that aren't really covered right now. I also wanted, so feel free to correct any of that. But the other thing I want to make sure that audience is catching here, and I think is essential to the conversation Jonathan and Alex just had about the future of it, is that right now, and this will maybe take us into talking about how the payouts are made, there's a risk with a parametric product, right, that you have a bigger or smaller loss than the amount you get paid, because the amount you get paid is sort of determined in advance, not by measurement of losses, and is triggered based on some measure of the hazard. Any of you want to add clarity?
Well, Alex,
go ahead, Jonathan.
No, I was gonna say this is probably one of my favorite topics. But essentially, think of it this way: there's really two models, right, that come into play when it comes to parametric insurance products, and it's sometimes it's easier to see them as two separate sets of problems. Problem number one is, can I detect an event? Right? So how do I detect that something has happened, whether that's a wildfire or a hurricane or a flood? Like, what do I need to know from like a sensor data perspective to be able to detect that something has happened? And you want to get really good at that, right? Because the better you get at that, the more accurately that you can determine that something has happened, and then you can do something based on that. So that's problem number one. And then problem number two that parametric policy has to solve is, based on what has been detected, from an intensity perspective, how much am I going to pay? Like, what are the losses, right, that I'm trying to cover based on that, right? So if we're looking at, let's say, hurricane wind speeds, right, you can assume that the stronger the hurricane is from like a wind speed perspective, the more damage there will be. How much damage is represented in business interruption, like how much you're not going to be able to operate, whether it's structural, whether it's relocation, excess expenses, like all these things. That's sort of the art and science that goes into a product where you want to calibrate for both of those. When one of those is heavily mismatched, either because of technical reasons or because something wasn't factored in right on the pay it scale, then you fall into what's known as basis risk, right? Whereas I had a loss or an event, and then my policy either didn't pay or the opposite happened. I didn't have a loss and the thing, the policy paid, right? So you're calibrating both of those functions basically to make it so that when something happens, people get compensation or safety net or remuneration based on what would be an expected loss given what was measured.
Yeah, so this conversation of basis risk has gone on for as long as I've been in the space, and I think there's a level of unfairness. While it exists, and we should talk about it, there's a level of unfairness because the assertion is that it exists in parametric insurance, and we're not talking about the basis risk that it exists in indemnity insurance, as if it's only clustered or in the parametric space alone. I mean, I know we're not doing polling here, but by a fake show of hands, how many people had a loss in their home or their business and said, you know what, that claim worked out exactly as I hoped and planned it to be? The answer is zero. Nobody raised their hands, right, in the privacy of their office, right? Not a single person was totally satisfied with the outcome of their claim. Why? Because things are excluded, things are sublimited, they have massive deductibles, right? If you have a named storm policy or if you have a California earthquake policy, you have large percentage deductibles. This is also the reason, because of basis risk, that so few people buy earthquake insurance in California. It's like, well, I got $1 million home. I've got a 25% deductible. Why am I going to pay $4,000 before I have to lose $250,000 out of pocket before I get $1 from the insurance coverage? I mean, that's also basis risk, right? So I think it's a unfair mischaracterization generally of the space. Now, does it exist? Is there a possibility that you could have a loss and not have a triggering event? Sure, but I'll give you an example because I do see there's a question about claims and actual triggering events. I have a client that is based in the Southeast. Hurricane Francine hit New Orleans on September 11th. The claim was paid and closed in 7 days. So on September 18th, the claim was paid. It covered 100% of their financial loss, and they suffered no physical damage. It was only intended to cover their BI, and that's exactly what it did. So I think that's a good use case.
All I'll add is shortfalls occur in every type of insurance, which is exactly what Alex just said, and occasionally windfalls occur in regular insurance as well.
Great, thank you guys. You've all kind of started touching on this, but let's dig in a little bit on some specific questions, because we did get a couple questions because of the wildfires that are going right now on the role that parametric might play in the future, particularly with households and the range of expenses that they face coming out of a severe disaster like the wildfires. There was questions about filling in some of the things you mentioned, deductible sublimits, whether parametrics could be complementary, and whether there was a possibility to add in a parametric component to a standard homeowners policy and blend solutions. So any thoughts on those issues?
Alex, you're the master at blended solutions.
I'm
voting for you to go first.
I feel like I talked too much, so I was staying quiet for a minute. I think it's absolutely possible. We see this quite a bit. I'm actually seeing this quite a bit in California wildfire, where there may not be sufficient capacity in the traditional market to underwrite a particular risk, in which case we see, again, quite often in certain classes around the LA basin and surrounding areas, where you'll have a traditional indemnity policy on, let's say, a homeowner's policy or some commercial risk, where wildfire is sublimited simply because the markets don't want to take on that aggregation of accumulation of exposure. And as a result, they buy a traditional indemnity policy that does have some wildfire coverage in it, and they would supplement it with parametric wildfire. And they work in tandem. You could almost think of it as like a quota share type of a structure, because the parametric is going to respond first and last in the context of wrapping around the gaps of the traditional indemnity coverage.
Jonathan, go ahead. I was going to take it away.
I'd say, since my experience is on the consumer-facing side, I would say that the opportunity for blended or combined solutions is it's a very exciting opportunity for admitted carriers to differentiate themselves by adding a feature to their indemnity coverage by saying, you know what, and this was a question that came in advance. Here's your regular homeowner's insurance, and we're going to add this feature that pays you, let's say $5, $10, $20,000 in the case of a major event, could be hurricane, could be earthquake, could it be any of the above, to compensate you for the pain and suffering, honestly, that you're going to experience, and not just the pain and suffering, but the additional expenses that you're going to experience. So I think that at some point, admitted carriers are going to really catch on to this opportunity to differentiate their insurance by adding a layer of parametric.
Jonathan, do you want to add anything to that?
No, I'm just some of the questions coming in are so good. I'm so
So
excited
good.
to get to
Yeah,
I'm
so
like,
good.
no, so the reality is it's all about finding the right approach for the given situation. I think blended insurance solutions really make sense in cases where there's clarity on like what exactly do you want to insure, and whether, I think what Kate mentioned is exactly it, like just understanding the needs of the specific audience that is acquiring or transferring the risk, and whether or not they need that capital immediately, and that would be helpful. And I think there's a lot of room there to just grow and improve existing products. But a lot of it comes down to just what are the specifics, right, of what you're trying to actually execute, and whether or not a blended solution or a single solution or one or the other really makes sense. And the line will probably blur a little bit as time goes by. At least that's my expectation.
That's great. Yeah, there's a lot of great questions coming in here. Again, a reminder that we'll follow up on any we can't get to via the blog, so don't worry. There's several questions about triggers. Those came in advance too, as well as a couple I see. But I want to just make sure we get in one that actually we got 2 or 3 different questions on, and I think relates to this, which is this question of cost and affordability. And this is, of course, a conversation that's much bigger than parametrics. That's all about risk transfer. But we had questions on whether insuring climate disasters through parametrics or otherwise could ever be affordable. What do you guys think about increasing risk causing problems for affordability? And if parametric options like Jumpstart, like what Raincoat supported in Puerto Rico, became more widespread in the US, is cost a barrier to getting people more access to those? So any thoughts on, willingness and ability to pay?
Yeah. So on the affordability topic, I always think affordability is a function of value, right? If you don't see the value in something, then there's no price you're willing to pay, right? I think people oftentimes, and this is certainly a barrier that I always have, is people are constantly comparing the pricing of a parametric to the pricing of a traditional indemnity policy. And I always say that's like comparing apples to doorknobs. Like they have nothing to do with each other. They're not even an orange. Right. They're just totally different functions and different value propositions. Right. And so if we were going to play the game of comparing traditional indemnity pricing to a parametric policy, then we would have to account for not only the premium, but the cost of the deductibles, the cost of the exclusions and the sublimits, et cetera. And certainly the delay, like the time, the net present value of time as it relates to filing and adjudicating a claim. So what I would say is that with a parametric, while the rating on a ceteris paribus basis is seemingly higher, that doesn't mean that you shouldn't still access it and just buy less. And this is always my guidance to people, is that you don't have to boil the ocean and buy $10 million of parametric coverage. Buy $1 million parametric coverage. By doing so, you haven't changed its value or performance or result in any way because you haven't modified the trigger. It's still going to respond in the same way. Why? Because there's no monetary deductible, there are no sublimits, there are no exclusions, and there's no loss adjuster. So there is always an affordable approach, and you just have to figure out, what are your budgetary constraints, and how do you fit it in? I think you can make space for it in whatever your existing purchase is.
I'll say that everything that Alex said, I agree with, because he's an expert. And in addition, what I'll add is that when you design the product, whether that's in advance for a consumer product or whether it's in a collaborative process with a sophisticated buyer, there's always the right balance between price, the probability of the parameter, the trigger, and the amount of money, which is the payout. And so if you're constrained on price, you can adjust these other two factors, which is the trigger and the payout. If you have a specific payout that you need, you adjust the trigger and the price accordingly. And in fact, you can set two of them and adjust only one if need be, but it's always a good idea to start with one and see what kind of latitude you have to adjust both of the other factors.
Thank you.
The only thing I would add to this, and some of the questions that have come in kind of related to sort of the applications, the appropriate applications of this, something that's been interesting for us is one of the most interesting aspects about parametric insurance is that it gives you a good view of real risk that isn't obfuscated by fine print. And what I mean by this is there are lots of cases where yes, the parametric price of a product can be very expensive, but it's not because there's anything wrong with how that product is structured. It's just that risk is very real and very common and very frequent and just a reality. And this aspect of affordability is really relevant within that context because someone is retaining the risk of that event happening. So let's say a farmer comes to me and says, I want to protect against drought in this region. And that farmer happens to suffer a drought, a real severe drought every 3 years. That's a real thing, right? That they need to consider within the factor of, for example, should you farm what you're farming in that region if you're getting a drought every 3 years? Obviously, if I structure a parametric product, a well-calibrated one that can detect that drought, I can definitely do it and I show it to the client might say, well, that's too expensive. But that doesn't eliminate the reality that this is just a legitimate real risk and like an actual issue. And I know a lot of the conversations that are going to happen, especially with the recent fires, there's a bunch of questions that come into legitimately some of these regions, some of these places are very, very, very high risk. And whether the people are retaining that risk at an individual level or trying to transfer that risk to someone else, that doesn't eliminate the reality that it's a actual very high risk location.
I think that's an important point and reminding people that insurance is one piece of broader risk management. And sometimes the solution is about risk reduction or something else and not the transferring of the risk. Before we leave this, I see a couple questions too around consumer education and understanding and how sophisticated do you have to be. And I think you all have some experience with different types of buyers. Correct me if I'm wrong, but Alex, I think you've worked more with some maybe more sophisticated public and corporate entities. I know Kate and Jonathan, you've both worked with households. Maybe you could each say a little bit about consumer interest and understanding and just perceptions and thoughts on the product.
Sure, I'll jump in. Jumpstart has not grown dramatically. We have a handful of adopters who understand earthquakes and understand insurance. But people, what we've learned from our customers, we've learned a lot of things. One of which is they don't want to educate themselves on a new category of insurance. They want it to be available and lumped into the buying process that they already know and love. Maybe that's insurance, but maybe it's an employee benefit, or maybe it's their property taxes. And I think that because of that, the most promising way to get the benefits of parametric to a very broad public is for sophisticated, I'm not going to say intermediaries, I'm going to say fiduciaries who understand the risk buying process and understand the needs of their stakeholders to be able to recover after an event. And it doesn't have to be a climate or weather event. It can be a man-made event. Those folks need to put on the risk management hat and say, how does parametric fit in for all of my constituents in addition to my organization? I'll give one example. So there is a large university system in California that also operates many of the hospitals in California, many of the major hospitals in California. And that large university system has a very sophisticated risk management knowledge and operations. And they would love to consider parametric payouts for their employees as an employee benefit, recognizing that, okay, yeah, the professors need maybe have some financial need, but what we really need operating after the next big disaster is the staff members at the hospital, so that they can get money to meet their first needs, take care of their families so that they can bring their best self sooner rather than later back to the hospital and take care of our community members. And right now they have not adopted Jumpstart, understandably, because the feedback was, we can't sell this upward to the regents of the university because until and unless we have a combined solution of earthquake, flood, and wildfire. And so, there's a process of working on developing those kinds of policies for the consumer level. But that's an example where the fiduciary who's thinking about their constituents or stakeholders has the power to really move the needle on the speed of recovery for their whole community.
To kind of add to what Kate's saying, 100% agreed. What you'll find in practice is that the amount of education related is inversely proportionally correlated to how well of a fit the solution is to the problem that you're trying to address. And what we've found is when we first started out and we developed some of the very first products, they were quite computationally complex. And people would push back and say, well, I think this is going to be too complicated for a consumer to understand and feel comfortable with it. And what we have found is that people interact with very complicated objects all the time on a daily basis, from the vehicle that you probably drove recently that has a lot of very complicated components to the cell phone, right? And the computer that you're using right now. All that really matters at the end of the day is it the right level of abstraction, and does it actually fit with the needs that the person actually has? Because when there are gaps in those needs, that's when you need quite a lot of explanation. So kind of like what Kate was mentioning, if there was a perfect parametric product that had every single peril and happened to just pay very accurately, very perfectly all the time, magically, then you would need very little education. A lot of the education comes in because you want to make sure that this is an educated buyer that understands the rough edges, right, of what you can actually provide given currently what's available. And the better you can get at that fit, like, is this the appropriate product for this specific issue? And am I capturing what I have to capture? Then turns out that the education barrier goes down quite significantly. And that's definitely been our experience.
I mean, maybe just adding from like this kind of the corporate commercial element, the level of awareness has gone up quite substantially over the last 5 years. I think in part because of COVID, actually, because a lot of these businesses say, well, geez, my COVID business interruption losses weren't covered. What else am I exposed to that's not covered? And so they start exploring other solutions in the market. So I would say at this point, most everybody in the commercial public sector realm knows what parametric insurance is. And that was not the case maybe 3 years ago. And I think now the question is, well, how do I implement it? What's the right purpose for this in my context? And so you're seeing that there's 5 U.S. states that carry parametric insurance. There's university systems, dozens of school districts and counties and cities across the country, aside from corporate actors, whether it's in the hospitality space, renewable energy space, et cetera. So the awareness has gone up quite dramatically. And I think Jonathan's right. The solutions today, it's kind of what Sam Altman said about ChatGPT, right? The ChatGPT that we have today is like the dumbest AI you're ever going to encounter, right? It's only going to get better from here. And I might say the same thing about the parametric solutions. I think they're fantastic and they've evolved so dramatically over the last 10 years. But these are the dumbest solutions we're going to see in this space on a going forward basis. They're going to improve dramatically. And I think we're going to see two industry trends. One is more predictive solutions. We're already seeing this in places like the Philippines or sub-Saharan Africa, where you have a mechanism that is anticipating a loss event and compensating the insured before the bad thing happens. So instead of writing a $100 million check after the bad thing happens, you're writing a $500,000 check before the bad thing happens to help them mitigate the loss. The second key trend I think we're going to see is peril agnostic solutions, right? So right now, you got to kind of pick your poison, right? Are we worried about earthquake? Are we worried about flood? Are we worried about named storm? What's the case, right? Pick your direction. But I think we're going to be able to use macroeconomic performance metrics, whether that be airline travel or hotel occupancy rates or credit card transaction data, as a barometer of risk at a localized level, which enables us to then cover not causality, but impact, right? And at the end of the day, that's what everybody cares about, is impact, not causality.
that led us beautifully into the next topic I wanted to pivot us into. So, which is we got several questions about trigger design. So could you, and that was opening up a whole future world of what those triggers could look like, which is very exciting. But could we step back 1 second and you guys share a little bit on like how are triggers set, what kind of thinking goes into them? And we got some questions on if you had a community or, you know, something beyond a person or a household who wanted to engage on how to do that trigger design. Can they? How does that process work? And another related question, I'll just throw it out, was about data needs and historic data to do all that. So trigger design, open comments.
Anyone want to go first?
I'm happy to go first on that. So when it comes to trigger design, I did see there was a question of like what type of data can be used. And so fundamentally, you really need two sets of things, or one set if it's complete. You need some sort of historical data set, right, that you can actually look at, whether it's a real, like raw, like this actually happened, or it's a what I call like a synthetic data set, like in the case of stochastic models for earthquakes and hurricanes. But you need some sort of data set that you can look at and utilize to be able to determine some degree of intensities or events that are happening over a large time period. And that one is super critical, very important. Sometimes you can deal with less data, sometimes you can deal with more, sometimes you can do estimates, but very important, right? That you have some sort of reliable data that you can use to make some sort of determination. And you need to make a determination on two fronts. What is the probability of something happening, right? Let's say if I have big data, what's the likelihood? And then the second thing is, how can I determine in real time or when it happens that that thing that I estimated the probability on has actually happened? And this can apply to any type of data, whether that is credit card information, like Alex said, right? I could build a product, a parametric product that pays whenever merchants see a reduction of 50% of their Visa transactions. What do I need to build that product? Well, I need a good historical catalog of Visa transactions, and I need an ability to determine when that has actually happened in real time for that business to then activate the cover and then pay them. And you can use this both for cases like this one that is not related to climate data at all, or you can use climate data, which is where we often see it. So that's kind of the process, right, of determining these things. And then the activations levels are all dependent on, as I said, the two functions that you're calibrating, your ability to detect it, and then how is that intensity of what you're detecting correlating to some sort of payment or loss.
Everything Jonathan just said, the likelihood has to be ability to be estimated, and the occurrence has to be measurable. But I'd say there's one more factor when you're working with the client who's going to buy this, which is that the trigger has to be plausible. It has to be something that they believe is going to happen. And on that note, I will say that one of the pieces of magic of Parametric is that it can help insure the perils that were previously uninsurable. It can't insure everything that's uninsurable because the probability of occurrence has to be measurable or estimatable. But what Parametric does is it caps the downside for the risk taker, for the insurer. So if you say, okay, I want to insure against a repeat of 9/11, okay, you can roughly estimate how often that's going to happen and put a probability on it and therefore a price. But you really don't know what the cost of that is going to be as an insurer from an actuarial point of view. And if you say, okay, well, I know if this thing happens, I know I'm only on the hook for this dollar amount, then it eliminates a whole branch of uncertainty for the case of actuarial modeling. And so it makes the coverage available where it otherwise might not have been.
Alex, do you want to add anything on that or on the
No, I
trigger?
think they covered it really well.
Let me add a few specific questions we've gotten that kind of follow up. I think you might have answered some of these, but I just want to make them specific. So one question came in about a recent hurricane that hit Houston, but the power outage stretched over 1 to 2 weeks and over 100 miles inland. So if your trigger's based on wind speed, could you capture events like this?
So that is a great case where there's multiple ways that you can try to resolve that problem. One is can you determine if there's a correlation between intensity of wind speed and what that time outage is? If the assumption is that there isn't necessarily a correlation there, or maybe there's some correlation, but not what you would expect, that's where you need to start layering other triggers, right, or other data sets. So maybe you're combining rain, flood, and wind speed to get a clearer picture of what's happening to a hurricane. That's if you're focusing on sort of the climate data side. If you don't want to do the climate data side, you can go down the route that Alex mentioned. Let's look at the power outage as the data set then. Let's look at what are the historicals that we have for power outages in this region. Can we, as Kate mentioned as well, can we estimate some sort of a probability that there's a power outage caused by any event? And then I'm going to actually just price that and then put a cap, right, over what I'm going to pay when that happens. So maybe every week that there's a power outage, I'm going to pay, I don't know, $1,000 per person. But that's it, right? That's the max, that's the limit, and then you measure that. So there's lots of ways that you can actually resolve that issue. It's all dependent on getting into the specifics, right, of the region, whether you have that type of historical data and what has caused prior events.
Yeah. Yeah, I mean, Jonathan's right about that. And frankly, this type of structure already exists in the market. There's new structures coming out, new capacity coming in behind it, specifically around power outages. But I'll give you sort of a corollary that's been around for a while, which is in the cyberspace, right? So there's parametric cyber covers. Now, they're not all encompassing. They're not covering, ransomware attacks and things of that nature, although I think they will at some point. But for example, cloud outage. Right, think of you're an online jeweler, right, and 80% of your sales occur between Thanksgiving and Christmas Day, and all your inventory, your payment processing, your sales, all goes through Amazon Web Services, and then Amazon Web Services, for whatever reason, goes down for several hours or several days in your region, and you are losing all that revenue. Right? You didn't suffer any physical damage, so your property insurance is not going to respond. It's basically a third-party liability exposure, but the data set behind that is actually quite robust. We have a lot of good data around when these cloud providers go out of service and how long they're down and how quickly they can get back up. And so that particular structure is going to compensate that online jeweler a fixed amount of money for every hour that this service is down.
Great, thanks. Okay, another one is a question about triggers that have multiple payout levels, and if those are still based, if the payout increases based on physical measurements, or you can use different data to set those payouts. I think, Kate, this also comes back to what you were saying before about the different variables that can go into kind of pricing and structure, but anyone want to add to that, how to have a tiered payout structure?
Yeah, I mean, it's all in the creative design of how you want to get paid. And this speaks to one of the questions that came through the chat, which is how is the payout determined? That's in the case of our consumer product, it was based on consumer research, like how much money is it going to take for you to be able to get over the hump in the first month after being able to suffering this extreme event. Even if your house doesn't get damaged, if the whole economy is disrupted, you're going to be able to need to cover at least a month's worth of expenses, maybe 2 months worth of expenses. And so that was a decision that we made at a corporate level, but based on consumer research. But on when Alex is working with his clients, it's a much more bespoke conversation, whether it's for tiered or whether it's for just a single trigger.
And we generally, in most cases, you're going to have a tiered structure, right? There's obviously a strong correlation between the intensity of the event and the amount of damage or impact it has on the ground. And so having a tiered structure, let's say the old school parametric structures, they were still tiered to a degree, but the steps were much more severe. And so the delta and the potential for basis risk was higher, right? Let's say you have a hurricane cover, it begins to pay you in a category 3, and then the next step is not until category 4, right? Which are, very different events. And so tiering it in most cases makes a lot of sense. When you look at parametric wildfire, it makes no sense to tier it, right? Because if you have an event within a certain proximity of your office building or your house, you need all the money, right? You don't need a sliver of the money. You need all of it.
Thanks. Those are helpful. Okay, I want to pivot slightly. There's been some discussion that one of the key benefits of Parametric is how fast it is. And Alex, you had that example about the payout being just days or whatever it was. Could you guys say a little bit about what determines the speed of payout? Are they always that fast? Are there certain factors that go into making sure that happens?
I mean, that's certainly the intent, right? I would say in the overwhelming majority of cases, a parametric claim is going to be paid and closed inside of 30 days. The record for the fastest parametric claim ever paid was 4 hours. And that's the intention, right? Because if we lose the speed of payment or we lose the flexibility, then why are we doing this at all, right? Those are the core tenets of a parametric structure. So the intent is always to be fast. But I'll tell you the honest truth, the thing that always slows it down is the insured. They're the ones that go, because we have the data in real time or near real time. We know almost instantaneously whether a structure has triggered. It's then getting the insured to fill out the one-page form to certify that they had financial impact and sending that in, which then releases the check. I mean, when Hurricane Milton hit in October, it hit 9 p.m. on a Wednesday. By 6 a.m. the next morning when I woke up, I had an email from the carrier saying, hey, this policy triggered, right? But then we were waiting for the insured to send the form so that we had to follow the protocol to get the money in their hands. And that delayed it by a couple of weeks.
To add to Alex, so we've seen quite a widespread. In the case of, like, for example, Hurricane Fiona in 2022, the policies activated immediately, essentially a couple hours, and then people had their money in their bank account within 48 hours. The real limitation is exactly what Alex says, is how much information do you have? It's actually one of the surprises that a lot of entities that we work with run into, whether it's government or insurers, and that is that they're so used to the claims process, which is a touch point from the beneficiary, right? They know that if following a standard normal insurance policy, the customer will come to them and then they have an opportunity to ask questions. But in a parametric context, all of a sudden you could have a huge community that gets all activated. You have a lump of money that just came in, and now you actually have to deploy that capital. So how much prep work you put in place can really make a big difference on that velocity. So we've had cases in some countries where we were protecting farmers and you had all the bank information of all those farmers already. And then as soon as the event happened, they received the deposit and everything was great. And we've had cases where none of that information was collected. And now you have to figure out how to fill out forms, how to get their information, and how to actually execute the payment. So it really is going to depend a lot on kind of how streamlined you put all that process in place so that then the benefit of the speed is there.
Great.
Yes, I'll just add that when we started Jumpstart in 2018, what we expected from our customers is that the number one thing they would appreciate is the speed of payment. And we have the systems in place to get people paid 24 to 48 hours after the earthquake. We have not had the privilege of actually delivering any payouts, but we did have a test of the system because we did have a triggering earthquake, but we had no customers because it was a very remote area. What we found, though, over the course of Jumpstart's existence over the last 7 years is the number one thing that people appreciate. They like the idea of the speed of payment, but what they like even better is the lack of arbitration, is the fact that they feel like they're on the level playing field, that it's an if-then relationship. It has the same feeling of a guarantee. Like, I'm just going to get the money. There's going to be nobody over my shoulder telling me whether I deserve the money. So the lack of arbitration is, and the feeling of a guarantee is actually very interesting.
Well said.
Great. Okay, we're down to the last 10 minutes. I'm going to see if we can get in one last question. And Kayla, if you can unmute Jonathan. Jonathan, you can weigh in on this, but the last question I wanted to get in before kind of some wrap-up thoughts was around regulation. We had a couple questions about the regulatory environment. That could go deep very quickly. Let's try not to do that. Keep it high level. Jonathan, maybe you want to say something about what happened in Puerto Rico.
Yeah.
Kate obviously gotten your products through all the West Coast states. So maybe just a couple high level thoughts.
Would love to. So regulation is, as Carolyn mentions, a really deep topic. And I would say that fundamentally, there's really just a couple aspects here that I think are the most important when it comes to regulation, or at least it's been my experience. Don't want to necessarily say are the most important, but just the ones that I've seen as being key. One is whether this is considered insurance or not is oftentimes like a big point of debate, right? And regulators will define the guardrails and rules for them to consider this insurance. And you can take this to extremes on why that concern would come. For example, if I buy an insurance policy that pays me $10 million on the hypothetical scenario of a Category 5 hurricane with insane winds, that stops being insurance and stops being insurance, starts being kind of gambling on the weather. So there's clearly some thinking that has to go in through the guardrails of what is considered insurance and why is this insurance. And obviously, I believe that this is insurance, but those rules, right, tend to be thoughtful around regulators. And then the second thing that, from our experience, has been really critical is how do you lower the barrier of risk for people to actually experiment with new products? Because oftentimes insurers, right, or banks or financial institutions or governments are conservative entities, right? They're not necessarily early adopters. And if you're going to try to build and develop a new solution and you're not even sure whether or not the regulator would accept it, and you're not even sure where the boundaries are, then you're going to be less likely, significantly less likely, in actually experimenting with that. So regulators can do a lot by simply defining baseline rules that create a little bit of a sandbox that allow people to then iterate and innovate. And that was what happened in Puerto Rico. They created a new law dedicated specifically to microinsurance parametric products. They defined the rules of what was allowed within that law, and that allowed companies like ours to get started and many of other products to flourish in the market. And it wasn't even like a really big, extensive thing. It was just, these are kind of the rules, these are the boundaries, and if you operate within them, you're good to experiment with solutions. I'm sure, Kate, you have a ton of experience with this as some of the first people to deploy these products.
Regulators their job is consumer protection, which includes getting more consumers protected. And so it's in their interest to help fill protection gaps. And for the most part, they want to be collaborative in getting innovative solutions, including parametric, out to the public when it's going to do some good and the insurers are not taking advantage of the public. I will say that parametric solutions do not have to be characterized as insurance. When they are directly for the consumer, we want them to be characterized as insurance so that the proceeds are not taxable. But for a corporation or a nonprofit to receive the funding and then distribute them to their constituents or stakeholders, it's really an open question about whether or not it has to be characterized as insurance or another financial product.
Great. Alex, do you want to add anything on that, or should we?
No, I think you've got. I mean, I'm sure I could talk for 20 minutes about it, but let's move on.
Okay, great. We're going to try to do two quick things. One is there were a couple questions about more innovative uses of parametric. So one that came up, Alex, that you actually touched on very briefly was using it in a preventative fashion to prevent losses. Another one that was raised is whether there's applications to nature and nature-based solutions. So any quick thoughts on these sort of more innovative that are less about sort of disaster recovery and about other types of benefits?
Yeah, sure. So I think going to nature-based first, because this is a quick and easy one to talk about. Back in 2016, we insured the Mesoamerican reef for the first time. And the parametric component of it was not the innovation. It was actually kind of the most basic kind of parametric hurricane cover that exists. But combined with the modeling data from the Nature Conservancy about the resilience of a reef, we were able to put this policy in place. The innovation of it all in the insurance space was the fact that we were insuring something that no one actually owned, and that honestly was the biggest revolutionary component of it. Basically the line of insurable interest that we drew was that the presence of the reef was what facilitated or created the beach, right? Without the reef, there would be no beach. Without the beach, there'd be no tourists, and those hotels would be empty. So hotel owners, you have a vested interest in the vitality of that reef. And so we were able to put that policy in place. And so I think that can be replicated on mangroves and wetlands. And again, obviously with parametric structures, there's some limitation in terms of, what type of risk or what specific peril you're addressing. Which hopefully will just improve over time. The second question about the predictive solutions. I'm going to try to make the story really, really short. But in Kenya, you have large populations of pastoral herders, and they're constantly moving around in different grazing lands. And when drought conditions ensue, they end up moving further afield from their tribal territories. Political violence ensues. People die. The military has to get deployed, and these people have lost their livelihoods. So the parametric structure was put in place using satellite data to detect the lushness of the vegetation. And when the grasses were beginning to diminish in their nutritional quality, right, turning yellow or brown, it immediately releases funds to the farmers' smartphones to call in feed and water trucks to their location. And because of that policy being in place, it's literally saving lives in rural parts of Kenya. And who's paying the premium on that? The Kenyan government. And why? What's their insurable interest? They don't have to deploy the military anymore.
Thanks for those examples, Alex. Okay, we're now going to do last question, which is going to be a round robin of you. You can say whatever you want to wrap up. If you're not clear what you want to say, then you can answer a last question that we got in advance, which was, what do you think are the most exciting concepts on the horizon right now for parametrics? Anyone ready to do that first?
Yeah,
okay.
my last comment, I don't want to leave this without mentioning, and it is my last comment, but it also kind of answers the other question, which is linking parametric insurance to climate adaptive measures. So when fiduciary, whether that's an individual or a landowner or a community, does resilience measures, takes measures that reduce the climate impacts or the impacts of man-made disasters, then how can we structure a parametric policy to account for that? So one example that I love is a community, a community in California called Isleton, which has created a multi-tiered insurance policy, the lowest tier of which is a parametric payout. And the idea is, okay, step one is just for the current condition, but in the next phase, when they have the funds to build the levee higher around their community, then the parametric cost of the parametric goes down because the trigger is if the flood breaches the levee. If the levee is higher, the likelihood goes down, therefore the cost of the parametric goes down. So I'm very excited about the future parametric and how it links to climate adaptation.
Great. Jonathan, you're up.
So on my end, the things that really excite me, my background's technical, so naturally that's kind of where my mind goes, is the idea of two things. One, multivariable, deeply complex data parametric products, the ones that can consume many, many, many data sets to get a much more accurate reading of a complex climatological situation. Those are really exciting. And it's incredible how good you can get when you calibrate the data well. And then the second thing is the applications within the financial sector. This is something that I've been talking about for years, and I'm starting to finally see it get in. And these types of solutions really make sense within the financial sector for two reasons. One, you know exactly where to pay because it's tied to either a bank account or a loan or something. And two, as someone I think mentioned in the comments, it can really cover real losses that stem from these events and can be very helpful in promoting more credit issuing in certain sectors that are heavily exposed to climate related. So those are two categories that really excite me.
Great. Alex, last word.
Okay. Okay. They covered good stuff. So I'm going to go a slightly different direction. I did see a question there about lenders. When we talk about sort of the broader application and growth of the parametric space, particularly in the context of an advanced economy like the United States, I do think lenders obviously play a very important role in the decisions that are made around risk transfer. They generally do not, I guess a broad statement, they generally don't accept parametric insurance. And I would argue it's because they generally don't understand it, or their requirements are slightly antiquated. And I do think that if there was a broader recognition of the value of the parametric in terms of its speed of recovery and the flexibility in the recovery, right? If you as a lender, if your chief concern is to ensure that the debt is going to be serviced in a timely and efficient manner, then what better mechanism than something that pays immediately with no restrictions, right? And so my hope and my wish is that more and more lenders will begin to take this up. We're starting to see some, breaking in the dam, but it's a long road ahead.
Wonderful. Okay, we are out of time. I want to thank all three of our experts for being so generous with their time and their expertise.